Hedge funds are at the center of the Reddit rebellion, and our next guest has been pretty vocal about the role he thinks hedge funds play in the market. Joining us right now to talk about investor trust and much more is Mark Levine. He's former chairman of the Illinois State Pension Fund. And Mark, thanks for being here today. It's good to see you.
Thanks for having me.
Let's get people up to speed who maybe aren't familiar with your story. You ran an Illinois pension fund with $24 billion on the behalf of, I think, 140,000 state employees, and you made all kinds of headlines when you came in back in 2015 because one of the very first moves you made was to fire a lot of the hedge funds that had been running money for that fund. Why did you do it, and what happened to the performance of the fund after that?
Right. So CNBC was actually quite helpful in making the headlines. So I really always appreciated that and continue to. What happened is we actually just got in, we took out a blank sheet of paper and looked at our entire allocation without any preconceived notions. And we started looking at these hedge funds, and our hedge funds were mostly of the stock picking variety, so not so much the derivative book, who are truly awful. But our hedge funds were actually benchmarked against something called the HFRI, which is total nonsense. We benchmarked them against stock markets, because they pick stocks, and they were net 60% long approximately. We didn't even penalize them on the huge gross exposures, right? Because they had about 140% long, 80% short, right? Just comparing the 60%, they were underperforming index funds, which we could get for free, by 150 basis points. And by the way, we had great guys. Okay, so this is the whole industry. The 2 and 20 was so devastating that even the best managers who can produce alpha actually destroy value for institutional investors, for all their investors. And so there was just no reason to stay with them. Now, one thing that we did do was we did retain some of them. We moved to the long-only vehicles, which actually have proper benchmarks, and you pay the carryover like an S&P 500 or whatever it is, and that actually worked out quite well. And the result of all this, we moved about 2/3 of our total portfolio to an index approach, and the other third, because of the challenges with pension funds, where because you're part of the government, you're sort of always under resourced, and you always have the risk of political meddling. The other third, we actually outsourced the selection of managers and really went for big alpha. And the result is today that portfolio is a top decile pension fund. Really proud of it.
So let's fast forward to today and what we're watching with the Reddit army kind of taking on these hedge funds. What do you think?
Yeah, so this is one of the things that was so frustrating. I also, by the way, served on the Illinois Teachers Board as sort of part of part of what I was doing here. And there was this view that, and they have a huge portfolio of the derivative book hedge fund. There's this view that hedge fund, that you don't need returns from hedge funds, which is completely ludicrous, and that they serve as a diversifier and they reduce risk. Well, right, for years now, hedge funds and many of the CIOs who sort of got stuck investing in them, right, have sort of taken this approach that somehow the derivative books and these short positions it's not just they have low risk or no risk, that they actually reduce risk, which is completely ludicrous. There's risk all over those portfolios. And so you should expect equity-like returns, okay, for the gross, right, on your gross exposure book, right, your longs and your shorts. So the beautiful thing about what took place last week is, for all my frustrating of theoretical risk, the world got to see exactly what it is, right? Which is that these short positions have unlimited downside. Derivative books have all kinds of sort of little sort of poisonous, elements inside them as well. These blowups are going to happen, right? 15 years ago, Amaret blew up, right? And the founder cried to Jamie Dimon, "Please don't, take my book." Right? This is going to continue to happen. There's risk in the books.
You say that when markets are tested, they emerge stronger. What do you think the outcome is here?
Yeah, no, for sure. So what hedge funds are going to have, of course, is all their customers, right? All their limited partners are going to be like, they're going to be asking this question, right? What are your gross exposure? All of a sudden, there's going to be consciousness of risk, right? So That and of course that's going to just go right internal. So I think we're going to have a reduction of risk, which is exactly the way the market should be working. And on, the beautiful thing is on the Robinhood side, where they were, badly undercapitalized, right, brokerage firm. The fact they raised the $3.5 billion over the weekend, and that their clients are now much more conscious, right, and perhaps will move right. I think it's the market. This is all the market working and the market kind of clearing the real damage that got done, particularly last Thursday.
Shepard Smith here. Thanks for watching CNBC on YouTube.